As you go and you start spending your money and investing in a property, you want to make sure that it's giving you the right rate of return. It's not just about buying the property, it's about buying the right one that's going to meet your goals. So being able to analyze these rental properties in the correct way is essential for all investors. How you do that is using the right financial performance metrics and right calculators to dictate what you want to buy. I'm James Dainard from the On the Market podcast, and today we're going to talk about how to analyze your next rental property utilizing the BiggerPockets Rental Calculator. Rental buyers must always narrow their buy box. What are they trying to achieve? What kind of properties are they trying to buy? Asset classes. How much money do they want to leave in the property? Are they okay leaving money in the property? Or should they go to more burst style property where they can get most of their cash back out? And then what is going to be the rate of return on that money? As investors, we all have a limited bucket of funds to go buy property with. We need to maximize those funds and make sure that we're hitting our minimum returns. And that's what this calculator is here to do, to show you whether you should buy or not. So we're going to dive in right now on a property that we are working on off market in the Pacific Northwest. For the last 20 years, we've been buying rental properties, apartment buildings, and acquiring more doors. We went from having 10 doors in 2008 to scaling all the way up to over 1,000 doors in the Pacific Northwest. We did this by utilizing the right tools. The right financial calculators like BiggerPockets Rental Calc is going to direct you as an investor. What should you be buying? If you buy the right things, it's a lot easier to scale. If we wouldn't have used these metrics, it would have been a lot harder to get from 10 doors to 1,000 because we would have been buying the wrong things. So we're going to dive in right now. We're going to look at a property that we're tracking off market right now. We have currently working with the seller. It could be a great potential rental property for us. It's going to hit the returns, but we have to buy it at the right price, especially with rates at an all-time high right now. We've seen rates skyrocket, double, triple over the last 12 months. This has made a huge financial impact on our cash flow. What can we buy and make it pencil? So using the calculators really directs us on what we should close on. So we're going to dive into this right now and show you the functions. You can get unlimited uses for the calculator by joining BiggerPockets Pro. Use the code word RENTALJ to get 20% off your pro annual subscription and a free digital copy of Real Estate by the Numbers by David Myers, so you will always be ready to calculate your next deal. Visit biggerpockets.com/pro upgrade to claim yours now. So the first thing you want to do is go to biggerpockets.com, sign up for the pro membership and get access to these great tools. Once you have this, you're going to click on tools and you're going to click on rental property. This is going to pull you up two options. One, to generate a new report, which is going to be your cash flow report on the property you're analyzing. And then next is your library of reports that you can click on and revisit properties. We leave our properties on here until that property has been sold to somebody else or the seller just says they're not selling anymore. Any opportunity that we've analyzed stays in there so we remember to revisit the property. Just because the seller didn't take our offer on the first go around doesn't mean they won't take it later. So by keeping it in front of us, it really maximizes us as investors. So typically in the Pacific Northwest, we're underwriting hundreds of properties a week. It can be for development, it can be for fix and flip and rental properties. Because we're going through so many properties, we want to keep them in front of us. And that's the purpose of the library. It keeps the property in front of you. You can revisit anytime. You can change your numbers as things change. We'll dig into that more in a second. But for now, we're going to look at how does this calculator function and how is it going to help you analyze that next deal. We all see properties out there that look like they're good value, but we want to make sure it meets our cash flow expectations. Just because we're buying a property below market value doesn't mean that that's the right property to buy. We want to check the cash flow. Is it going to get us the return that we want? So before you get into the calculator, you need to do your rough underwriting first. So for more information on underwriting, check out our underwriting videos on BiggerPockets YouTube channel, James Dainard, How to Underwrite Your Next Deal, and this can help you compile the information. Before you use this calculator, you need to do a couple things. The first thing is get pictures of the property. What is the condition? That's going to tell you whether you need to rehab the property or not. This matters because when you're buying a rental property, many times you're putting 15 to 20% down, depending on the lender you're using, and depending on whether you have a construction loan or not, you're going to have to come out of pocket for your rehab. That means you have more cash in the deal, 20% down plus your rehab, you're going to have more like 30% down on the deal rather than 20. The more cash you have in there, the higher your cash flow you want to be. You want to get to your returns. So it's a very important thing to know. So before we use the calculator, calculator, we evaluate the property. Here was photos of it. As we can see, it needed a lot of work. It had lots of deferred maintenance. We can go through, there was some mold going on. It needed cabinets, flooring, countertops. It needed a lot of work. This is actually a fairly good BRRRR property, it looks like. After reviewing the pictures and the conditions, we can kind of come up with a rehab. We thought that it was going to cost $115,000 to get it to highest and best use. We then have to pull the comparables for the properties. There's two comparables we need to pull every time. One is the after repaired value. That's going to help us with bank leverage. What will this property be worth when it's all said and done? It's important to know what your equity position is on any type of rental property. Sometimes it's none. You're buying something turnkey and you're chasing cash flow. That's totally okay. But if you are doing the work, you want to make sure that you have some sort of value increase. So on this property, we figured it was, after running comparables, we could buy it for around $400 to $420. We could put $115,000 into the property and it would be worth about $680 after we pulled our comparables for the property. From there, the next thing we need to do is pull our rent comparables. What will this property rent for in the same like for condition? We are now putting a substantial renovation in. It's going to be a class B or A product. It's going to get a higher attractive rental tenant at that point. That's going to get us higher rent. We want to source rent comparables that are of the same bedroom, bathroom count, the same finish level, and pull the income. We did that and the rent was going to be about $4,000 a month on this property. By compiling this information before we use the calculator, we're prepared, and now we need to figure out whether this makes money or not. So after underwriting the property, we're going to input the information. So the seller was asking for $400,000 for the property right here. We know in Washington it costs us about 1% of closing costs to close that transaction. That's going to be about $4,000. But if you want to get more granular and break down the cost specifically, you can then click advanced, hit points, origination, hazard insurance, annual assessments. All the different types of costs are all listed out in here for you to input in. Also customs, so you can add in any kind of closing costs that you may have. So the more granular you get, the more accurate your numbers are going to be. But for now, we're going to stick with the $4,000. We then click next loan details, and then it's going to ask, how are you purchasing this property up front? On this specific property, we were looking at using a conventional lender with 20% down. We will mark what our down payment is, and then we need to input what our interest rate is. Again, on this rental property, many times we're not using a hard money loan, we're using a conventional lender. They require 20% down, and our current investor rates in today's market is around 8.5% to 9% for investors. How we find that out is we call our mortgage team. Every time we're looking at a rental property, we get an update on our rates. As rates are climbing rapidly, it's really important for you to do so. So we called our mortgage officer and they gave us a rate at 8.75%. We then input that rate and we start breaking down the other charges. Our mortgage company charges us 1% origination fee to close that transaction. The loan terms we're doing is a 30-year fixed mortgage. So we're going to enter in the terms at 30 years. And then it brings us to the next box, which is the rental income. The rental income is what you get from your property comps. When we pulled our comparables for like renovated properties with the same bedroom count, it was generating $4,000 a month in income. We're going to input in our monthly income, and if you have a multifamily property, you can break it down with other types of income. You could add in rent, laundry service, water reimbursement. It could be parking, it can be storage. So any type of rent income you can break down this way. But on this one, we're just getting a straight $4,000, so we're going to enter that in. We then go on to the next, and this is where we need to back down our expenses. What is affecting that $4,000 a month? The first thing is we have annual taxes at roughly about $4,500 for this property. Our annual insurance is about $150 a month, which is going to be about $1,800 for the year. And then we're going to break down our other costs against the rental property. Typically, we plan for 1% repairs and maintenance on each property. Our vacancy rate, we run at 3%. The vacancy rate is the time that you have to lease the property, that dead time on your money. The longer your wait time, the less your return is going to be. On average, many times vacancy rate is 3 to 5%. If you're in multifamily, it kind of hovers in that 3 to 5% range. If you're in single family, it can drop down to 1 to 3 because many times the tenants don't turn as much. But for now, we're going to put in 3%. And then capital expenditures, we're going to add in 1%. That's going to allocate 1% budget that gives us more capital to put back in the property whenever we need it. After that, you can account for your management fees. Many of us investors, I know for the first 10 years, I managed every property myself. As as I grew in my investing career, I started bringing in property management because I needed more time. My property manager, because we give them a lot of units, charges me 5%. I'm going to input in that cost at that point, and then we're going to back down any other fees that we need that we might be providing for the tenant. Now in Seattle, when we're renting a single family house, the tenant is going to pay all their utilities that go into their names. But depending on your market, you might be paying the electrical, you might be paying the gas, the water, sewer, garbage. You want to input the costs that are yours. So I'm not going to input anything else, but if you have those costs, input them in. HOA fees, garbage, anything else that is going to be an expense on the income you want to input to get the right information. Now, once you've inputted the values, the price, the rent, the costs, then you can calculate your report. The awesome thing about this report is it breaks everything down for you. So as we're looking at this, it summarized what the deal is. This was telling me we were looking at making $558 a month in cash flow. The income at $4,000 minus expenses at $3,400, that was giving me a 7.68% return. Not too bad. Pretty good deal. And so the nice thing about this report is it gives you the highlights at the very top. So below that though, you can start really messing with it to see what the performance can be. For example, if rent growth is high in my market, let's say Seattle is jumping at 10% like it's done historically the last couple of years, which is pretty high, but it's been doing it. I can look at this deal today and then go, hey, I might like this deal today, but in 1 year, is it going to get better? If it jumps up 10%, my rent goes to $4,400. That's now going to tell me I have $918 in cash flow. So you can play with this tool and project down the road as well. It's a really cool thing. In addition to, you can play with your expenses. If you think that your property taxes are going up, or maybe you're in Texas or some of these other markets where the property insurance is jumping through the roof, you can see what the impact's going to be every month on that. It's a very versatile calculator. You can play with loan amount, interest rate, management fees. So I know what we're doing right now in today's market is rates are high 8.8%, but if I wait it out for 2 years and I can get it down into the fives, what is that going to look like? That is going to give me $997 in cash flow, which is a 13% return. Once you're done with the report, you save it and it goes into My Active Reports. What My Active Reports does is it saves every potential property that you've underwritten. You get to keep it in front of you. So at any time I can revisit a property. So right now we have a property in Spanaway that we're looking at. It had an 8% cash on cash return. That's a higher return. That's kind of where I want my margins to be at. I actually want to be at 10 in these specific neighborhood. But this tells me I'm really close on this deal and I should stay in front of it. And then when we jump over to this other property, you can see the highlights real quick. This was a negative 1% return. That means I'm going to need to get this property substantially cheaper to get to my 10% return that I'm chasing. So the nice thing about this is it keeps the deals in front of me, but I go to the ones that I'm closest with. If I'm going to spend time this week working one deal, it's going to be on this seller right here where it has an 8% return. I'm closer to getting a transaction done. We're not as far apart. If I'm going over to this renting property is a negative 1% return, I'm going to work on that sporadically. I might check with that seller once a month rather than once a week. Give them a little bit of time because time is going to take it to get the price down. I need the price down to get to my return. So it helps you maximize your time. In addition to, as things change, you can update your records. Let's look at this deal that's a negative 1%. I don't like it. I have a quote right now from a mortgage officer that my rate's going to be around 8.5% to 8.75%. If I find a new lender, let's say a portfolio lender where the debt cost could be cheaper and I can get a loan, let's say at 6.75% now. So as an investor, I got one loan quote and I just sourced cheaper money. That can change my deal. And this calculator helps you adjust your numbers very rapidly in showing you the financial impact of the deal. We were at 8.5%. Let's say we get down to 6.7% or 6.6%. Now we went from a negative 1 cash flow where we were losing money every month to positive cash flow at $428, a 2.46% return. Now, it doesn't meet my minimum return, but it's bridging the gap. I didn't have to negotiate the seller down that far in price. It was more getting the right tools, the right cheaper money to get closer to the seller. Now, as I'm closer to the seller, I can now negotiate the price down a lot less and I have a higher probability of transacting on it. So again, the dashboard is beautiful for investors. It keeps it organized as you get more resources in, whether it's cheaper construction, cheaper money, whether the price is coming down, you can update it in real time, keep track of it. Keeping track of it is going to help you transact and get you to your goals faster. So as investors, make sure you're utilizing the right tools. You want to know what to buy and when to buy and how to buy. The BiggerPockets Rental Calculator is going to help you do all those things. So utilize these tools. Protect yourselves as investors. If you enjoyed this video, make sure you like and subscribe below. And for more information on how to analyze your next rental property, check me out on Instagram at jdainflips or on jamesdainard.com. And I look forward to seeing everybody on the next On the Market podcast.